Hey everyone, welcome to today's video. So you might have seen in the news that the US is going to cut interest rate this year. Well, it is not clear yet when it is going to happen, but it is certain that by December 2024, 3 to 4 cuts approximately will be made in the interest rates. But the question is why there is a need to cut the interest rates or why the interest rates are even increased. So in this video, we'll be discussing about what is the effect of rising or cutting down the interest rates on the consumers and the investors both. So let's get into it. So the central banks like RBI in India and the Federal Reserve in the US has the responsibility that the economy of the country should be healthy. One way the central banks ensure that the economy is moving at a good pace is by regulating the interest rates at which the banks borrow money from the large banks. So if we look at this particular chart, banks borrow money from the large banks in the overnight markets. And the interest rate at which these banks borrow money from the large banks is called the policy rates. And when we hear the news that the interest rates are going to be cut or increased, most of the time, these are the interest rates that the news are talking about. Now, if the interest rates are cut, that means the banks will be borrowing money with the lower interest rates from the larger banks. Hence, consumers or the small businesses will be also borrowing money from the banks at a lower interest rates as well. This means consumers will be able to borrow more money to buy for some larger purchases like homes, etc., hence leading to lower interest rates for their home loans. Similarly, for businesses, if we look at these businesses also will able to borrow money at a lower cost, hence they will have more money to spend that will in turn increase in the employment rate as they have more money to spend. But if we look at this particular scenario where the interest rates are decreased and consumers will have more money to spend, businesses have more money to invest in the profitable businesses, then what is the reason that the interest rates are increased on the first place? Well, the answer to that is if we look at a particular graph. So let's say if we look at this particular graph, we can see that there is a sustainable growth rate at which the GDP should rise. When we see that the GDP is growing more than the sustainable rate of growth, this is actually a problem. And most of the time, this is referred to as the bubble being burst or the markets are overpriced. Because what happens at this particular point is as more people have more money to spend, the companies are also going to increase the value of their products. Hence, it is going to rise the value of all the products, hence, increasing the inflation rate. And in return, as the inflation increases, the wealth of the consumer also diminishes. So, to counter this problem, governments or the central banks like the RBI or the Federal Reserve often increase the interest rates, and this causes consumers or the businesses to not to borrow that much money, hence regulating the demand and supply in the economy. So this year interest rates are going to be cut. And is this good for both consumers and investors? Well, it's not like what we see. So if we look at consumers, the interest rates are going to be cut. Hence, people are going to get lower interest rates on the upcoming loans that they take. But this will not influence the interest rates of the fixed loans that these people already have. But if we look at in terms of investments, it is going to be good for the stock markets because as businesses are able to borrow more money, they are going to deploy that money into their business operations, hence increasing the stock valuations. But the one thing to take care of is the bond markets because if we buy bonds at the current market when the interest rates are high, we can have bonds with higher coupon payments and hence we'll be making more money through bonds. But if we take bonds when the interest rates are cut, hence companies will not be willing to pay higher interest rates or the higher coupon payments on those bonds that will be in the market at that time. So investments, bond markets is a good place to be in right now. But in the stock market, if we want to invest, it will be better if we wait for the interest rate cuts. Or interest rates cuts are good for the economy because of the employment rates that we have seen recently. There are thousands of layoffs these are also going to be reduced. So these were the reasons why the central banks like the RBI or the Federal Reserve actually regulate the interest rates. So that's it for today. See you in the next one.